Hello and welcome to your weekly technical update, your guide to the charts that matter this week. I'm Andrew Gagan. Well, global equity markets have remained relatively resilient since the outbreak of war in the Middle East. Late last week, we checked in with Jason McIntosh from Motion Trader for technical analysis of the S&P ASX 200.
Looking at the ASX 200, it's one of the quickest reversals from an all-time high to a 3-month low ever, just 6 days. So understandably, that sort of volatility puts people on edge, but volatility doesn't necessarily signal a bear market. I think what's going to be important now is the next rebound. Is it a shallow, lackluster bounce? And then that would suggest selling of the rally. That wouldn't be great. Or do we get a strong V-shaped recovery as we've seen at other times in the past? That's what we need to be on watch for now. Now, the last component I want to quickly jump to, it's the ASX 200 equal weight. And, well, this chart has been cause for caution for the last several weeks, with prices consolidating below the moving averages. You can see that blue circle on the graph. You can see the consolidation below moving averages. That's always a point of vulnerability. Monday's breakdown worsens that structure. But given what I've said about the materials and financials, I don't think we should be jumping to the worst case scenario. Like I was saying with the ASX 200, I think we need to monitor what the next rebound looks like. Is it shallow or do prices bounce back strongly? A shallow rebound, well, that would be below declining moving averages. That would be concerning. So as I say, we need to watch the rebound closely.
Yep.
Andrew, my approach here, it's keep holding profitable positions, but have a plan to sell stocks that break down. At this stage, we've got volatility and a pullback. We don't have a full-on bear market. So I think it's stick to your plan and keep emotions to the side.
Well, since the outbreak of the conflict, oil prices have surged almost on a daily basis. But Michael Gable from Fairmont Equity says higher energy prices won't just be constrained to oil, with it already flowing into other commodities such as uranium.
So countries will look for other alternative forms of energy, and they're already doing that, and that's in coal and uranium. So here's a fantastic looking chart. This is Bannerman Energy, a uranium developer. So this is a monthly chart that I've converted to a log scale, and I did this with silver about a year ago because it demonstrates a very bullish pattern, and that's the cup and handle, which is basically the blue pattern on the far right hand side. So to me it looks like it's building up for a very strong move. It was almost about to break out of that pattern a few weeks ago before the war started. I think that the buying will emerge again pretty soon, and if you see a break above $5, I think that could add a few dollars on top of that. So Bannerman Energy, it's a smaller one, Aussie developer in Namibia, but looking very bullish.
And with renewables not quite meeting demand expectations, Michael Gable says part of that gap is being filled with coal. Here he breaks down the chart for Whitehaven Coal.
You've got a coal mine, you're sitting on a gold mine, really. Probably not the best analogy, but so as we could see, coal prices, the coal stocks are starting to break out, and I suspect coal prices will really ramp up as countries look for alternative forms of energy. So Whitehaven Coal, we could see on the left-hand side, had that massive run in 21-22 with the outbreak of the war in Ukraine. We could see it's consolidated for a few years. That's in those blue lines, and then it's started to break higher. It's doing that now. I suspect we'll see significantly higher levels in Whitehaven Coal from here.
And that's it for this week's edition of The Charts to Watch. Join us for more technical talk next week. Happy trading.